Hello and welcome to the Daily Brief Show by Zerodha. Here we cut through the noise and bring you the most important stories that move the markets. I am your host Anurag Bansal, and in today's episode we'll talk about four big stories. In the first story, we'll talk about what SEBI's chairperson is saying about the markets. In the second story, we'll talk about what the World Bank said about countries growing from middle class to rich. In the third story, we'll talk about whether or not the US will undergo a recession. And in the final story, we'll understand SEBI's new proposal regarding allotment of bonus shares for investors. So let's begin. Recently, the SEBI chairperson, Ms. Puri Buch, addressed a conference gathering. She spoke at length about various issues related to the stock market and what SEBI is doing about them. One key topic she spoke about was SEBI's initiatives related to the ease of doing business in India. To implement this, SEBI has recently set up 16 working groups. These groups include various market stakeholders like exchanges, clearing corporations, depositories, brokers, listed companies, and AMCs, and also alternate investment funds. SEBI's larger idea here is to help businesses by reducing compliance burden, streamlining processes that are currently long and complicated, improving investor protection, and also facilitating faster access to capital. On the faster access to capital part, SEBI chair Ms. Puri Buch spoke at length about how SEBI is doing this. She mentioned that India ranks number 1 globally in terms of the total number of IPOs and new issuances. However, the problem is that our IPO processing time of about 3 to 4 months is still very slow. And that is why SEBI is now focused on reducing the processing time of IPOs. And as a solution, they are looking to create a demystified IPO document. Now, this demystified IPO document will be a template or fill in the blank style document with key points to cover all details of a company. SEBI's idea through this is to make the process less intimidating for companies and more informative for investors. Now, since this information will be in a very specific format, the advantage that it gives us is that it would automatically reduce the processing time for IPOs. By the way, here if you're wondering why faster processing of IPO application is important and how it really helps, let me explain it to you. See, a shorter timeline lowers the risk of market conditions changing between the IPO filing date and the IPO listing date. Now, given that the markets are very unpredictable, this is a very critical element. And more listings are positive and critical for the markets because of another interesting point that the SEBI chairperson mentioned during her speech. She pointed out that there is currently a mismatch between the demand and supply of securities in the market. I'll explain this to you in simpler words. See, in the last 3 years, about 3.1 lakh crore rupees have been invested in the secondary market every year by mutual funds, domestic institutional investors, and individual investors. But on the other hand, only 2 lakh crore rupees worth of new stocks have been issued each year through IPOs and follow-on public offerings. In other words, flows are chasing a limited number of securities in the market. According to SEBI, this is leading to an increase in the prices of existing stocks without much business growth to support it. Intuitively speaking, this is bad for the growth of our markets and the larger economy. Ambit Research also highlighted something on similar lines in a very recent report they released. They said that availability factor of Indian equities, which measures the ratio of available stocks to mutual funds demand, has been shrinking over the past 7 years. This is because the demand for Indian stocks from domestic mutual funds has grown faster than the supply of freely tradable shares. The effect has been most pronounced in large cap stocks where the availability factor has decreased by 48% as compared to 33% for mid caps and 27% for small cap stocks. In the last year alone, large cap availability factor or AF dropped by about 9%. This trend has led to higher stock prices as more money chases a limited supply of shares, particularly in the large cap segment. Moving on to the second story for today, the World Bank recently published a report on what developing economies can do to avoid the middle income trap. This is a 276-page report, so instead of going line by line and boring you, let me give you a broader idea about the whole thing. See, for starters, the report, as I said, revolves around the idea of middle income trap. In simple words, this means that once countries reach a certain income level, they often get stuck and find it very hard to keep growing. Poor countries can grow quickly because they have a lot of room to improve and they can start by throwing money at easier problems. Richer countries can grow because they've already solved a bunch of problems with their economy in the past. But the real problem lies with middle income countries. See, these countries have to overcome incredibly hard challenges as they go if they want to really grow. Loosely speaking, you can think of it like getting stuck in the middle of a mountain climb. There is still a long way to go to reach your destination, but you're already tired to go up. Now, becoming a high income country is like a miracle and it is not really guaranteed. You need to get a lot of things right, and as we speak today, India is a middle income country. For countries that are stuck in the middle like India, growth becomes really tricky. We have already made many of the obvious improvements we had to make, but we still have a long way to go. The problem with growing further as a middle income country is that the simple solutions that worked when the country was poorer do not have the same impact anymore. To go further ahead, you need to compete against creative, technologically advanced businesses from across the world. So you need to start using advanced technologies and innovate as fast as possible. And this is much harder because it requires a lot of skills, money, and also good policies. Breaking out of this trap becomes even harder because many of the opportunities that helped other countries in the past are now gone. For example, countries like China and Korea grew really fast in the past by focusing on exporting goods to the rest of the world. Their rise coincided with a period of unprecedented globalization when advanced economies actively encouraged them to become factories of the world. But that period has now ended and countries are becoming increasingly protectionist. India does not have the same opportunities today as China and Korea did in the past. So, what is the solution, you may be wondering? See, most poor countries grow by drawing investments. For middle income countries like India, the World Bank recommends focusing on two more strategies. First is infusion. See, in order to grow, countries need to bring in and adapt technologies from advanced countries and then infuse them throughout their economy in order to improve technologically. Second is innovation. See, once countries reach technological parity with advanced economies, they need to look for advantages that help them push competitors out. This requires innovation and it is hard to achieve because it requires countries to provide the right conditions to foster innovation. Joseph Schumpeter, who is an economist, introduced economics to the idea of creative destruction. He said that an economy constantly faces three forces: creation, perseveration, and destruction. New businesses enter the market, successful ones grow, and the bad ones are destroyed. Successful economies maintain a balance between these three parts of the cycle. In middle income countries, there are two imbalances in this very cycle. One is that fewer new businesses enter the economy, which slows down the creation of new ideas and technologies. And two, incumbents are kept alive on life support, and a few companies are destroyed. As a result, established businesses are protected from dying and being killed off by new competitors. This means that the perseveration part of the cycle is dominant. They become complacent and rely on existing products without any innovation. With fewer new businesses and less innovation, the economy can really start getting stuck in the middle income trap. But the real question is, how does the country get this balance just right? Here is what the World Bank says. First, discipline incumbents, which means make sure big established businesses do not block new competitors or prevent innovation. This can be done by promoting a fair competition and preventing monopolies. Second is rewarding merit and encouraging support to talented people and good ideas no matter where they come from. This means giving opportunities to those who show potential and have innovative ideas. Third is to make best use of crisis times. See, using tough times like economic or environmental crisis, these situations can help push through reforms that are needed for growth but might be hard to implement in another normal scenario. But the question still is, will India escape from the middle income trap? I guess our generation will end up finding out. Moving on to the next and the third story for the day, let's look at if all the narrative around US recession is really true. See, we humans have various quirks, because of which we do a lot of strange and weird things. One such weird or strange thing that we do is that we are prone to confirmation bias. In simpler words, we look for or process information in a way that confirms our pre-existing beliefs. Now, why am I saying all of this? See, as I explained in yesterday's episode, the global financial markets, including India, are looking quite bearish at this moment. And as I stressed in yesterday's episode too, we have absolutely no idea why the markets are spooked right now. But one factor that seems to be causing this bearishness is supposedly the increasing odds of recession in the United States. See, last week the US jobs data came in and it was quite disappointing. The US unemployment report hit a high which was last seen in October 2021. This bad jobs report sparked fears that the US is at a high risk of recession, if not already in one. And this jobs report also triggered something called the SAM rule. I know that sounds complicated, so let me explain. See, the SAM rule is a recession indicator that was created by a person called Claudia Sahm. Claudia Sahm was a former economist at the US Federal Reserve. The indicator says that the US economy will be in a recession when the 3-month moving average of the national unemployment rate rises by 0.5 percentage points or moves above its low during the previous 12 months. Some use the unemployment rate because once it starts rising, it tends to keep rising because bad economic momentum feeds on itself. If the unemployment rate keeps going, that means the economy is in a bad shape and probably in or is entering a recession period. Now, again, you might be wondering, why am I talking about this? Look, when the sentiment is bad, people expect the markets to remain bearish and they often look for confirmation signals. The fact that right now the dominant sentiment is bearish means people are picking up on indicators to confirm their bearish bias, like the SAM rule. But can the SAM rule be wrong? See, Sam herself had written that the SAM rule is a historical pattern, not a law of nature. She also recently wrote that a recession is not imminent even though the SAM rule is close to triggering. She also said that the SAM rule is likely overstating the labor market's weakening due to unusual shifts in labor supply caused by the pandemic and immigration. The risk of substantial weakening or a recession in the next several months is elevated, adding to the case for the Fed to begin cutting rates. So yeah, largely speaking, you can't just take one indicator and predict a recession. So that said, the other recession indicator that is getting attention is the US yield curve. See, a yield curve is a graph that shows the relationship between interest rates and the time to maturity of debt for a given borrower, which is usually the government. This curve plots the yield of bonds against their maturities, which ranges from short term to long term. Changes in the shape of the yield curve give you insights into investor expectations about the future interest rates, economic growth, and potential changes in monetary policy. Typically, a normal yield curve is upward sloping, meaning that longer term bonds have higher yields compared to shorter term bonds. And that is how you would normally expect things as well. A 1-year bond pays more than a 10-year bond. A normal upward sloping yield curve tells you that the economy is healthy. But sometimes a yield curve can invert as well. This means that the interest rate on short-term borrowings are higher than the interest rates on long-term bonds. And that might sound weird, right? Well, the US government bond yield curve has been inverted since 2022. This means that a 3-month US government treasury bill is paying a higher interest rate than a 10-year government bond. Why? That is because the US Fed hiked rates massively, which pushed short-term bond yields higher. At the same time, investors were expecting inflation to fall and the US to enter a recession, which pushed down long-term bond yields. An inverted yield curve is seen as a recession indicator, and historically, recessions have occurred anywhere between 6 to 22 months after the yield curve inverted. And right now, it has been 23 months since one part of the yield curve has inverted. By the way, on a side note, the yield curve inversion does not really have the same predictive power for recession everywhere. They tend to be stronger in advanced economies and weaker in emerging markets like India. As a fun fact, the Indian government bond yield curve was inverted earlier this year and we aren't quite in a recession very clearly. But coming back to the US yield curve, some experts are saying that it's not the inverted curve that predicts a recession, but rather the curve uninverting. This means that when an inverted yield curve becomes normal, it predicts a recession. The time between a curve uninverting and recession is usually 66 days according to an analysis. Right now, the US 10-year treasury bond minus the 2-year treasury bond is close to uninverting. And that means until now, the 2-year bond has given a higher yield than the 10-year bond, which is abnormal, but the situation is still normalizing. Now, this is causing worries, and the disinversion is predicting a recession. And this is funny that it is happening at the same time where people are screaming that the US is entering or is already in a recession. Economic indicators are never perfect. A statistician famously said, "All models are wrong, some are useful." And this is a perfect way to think about this. People who are bearish will use any available evidence to confirm their pre-existing biases, and that is what is happening here. The bear wants bearish evidence. Now moving on to the fourth and the final story of the day, SEBI recently made a new proposal to streamline the allotment of bonus shares for investors. This proposal aims to address the current issues and introduces a standardized approach. But before getting into the details, I'll quickly set some context for you and explain how things currently work today. See, first, companies announce a bonus issue after their board's approval. They then set a record date to decide who gets the bonus shares. Then the shares are credited to eligible shareholders' accounts, and finally, new shares start trading. Now, while this sounds very simple and straightforward, the problem is that there is no uniformity in this process. Some companies can list within 15 days of approval, while some take up to 2 months as well. Now, this leads to investors being exposed to market volatility very unnecessarily. The SEBI is now proposing a T plus 2 day allotment timeline for bonus shares. I'll explain what they mean. See, on T day or on record date, bonus shares are allotted to those who are eligible. On T plus 1 day, shares are credited to the account of eligible shareholders, and on T plus 2 day, trading begins with the revised share price. Also, as per the new proposal rules, companies will need to apply for an in principle approval from the stock exchange within 5 working days of their board's approval. These timelines will be consistent for all companies under all circumstances. Now, if you're wondering why SEBI is doing this, I'll explain that as well. See, doing this first cuts down the time between the record date and when the trading starts. This means investors are less exposed to the market volatility. And second, it makes the whole process more predictable for the investors. This suggestion, if implemented, can have some really positive effects on the market. I'll explain this with a very easy example. See, imagine a company has set 1st January as the record date for a 1:9 bonus issue. This means for every 1 share you own, you get 9 shares as bonus. Now assume you buy one stock of that company for 100 rupees on 1st January. As per the rule, you are eligible for the bonus allotment. Now, according to the current scenario, on 2nd January, the stock would start trading at 10 rupees instead of the previous 100 rupees because of the bonus issue. Theoretically, that's okay because now you have 10 shares instead of 1, so your net value still remains the same. But the catch here is that the 9 bonus stocks that you are eligible for would still take some time to reflect in your demat account. The biggest problem today is that there is no clarity on that particular time. So effectively, in this case, you're only left with 1 stock out of the 10 stocks you own until the company decides to give you the remaining 9. This means you cannot sell them even if you wanted to, and that is very strange if you think about it. This is exactly what SEBI is trying to fix with the new rule. According to SEBI's new proposal, this particular waiting period will be reduced to T plus 2 days. Going back to the example I was talking to you about, this means you will get your remaining 9 shares by 3rd January, which is 2nd January plus 1 day. So if this rule is implemented by SEBI, it would be a really good one to give investors more protection and stability in the markets. That's all the news I have for you today. I'll see you in tomorrow's episode. Take care and goodbye.